Since 1987, we've helped investors navigate the markets using technical research focused on relative strength, supply and demand, and momentum. From sector rotation to asset class rankings, we highlight what drives performance. Nasdaq Dorsey Wright, helping you stay one step ahead.
Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast for Wednesday, June 17th. My name is Ian Saunders, joined here by David Clark. David, good to see you.
Pleasure to be back on.
Yeah, it's always good to have you here. It's good to have you up in town. We're coming up. I don't know if you're coming up here to see everybody in the office or because we're playing golf after work today.
I mean, both are motivational factors.
Both, yeah, both are good. It's I'll certainly be motivated to find my ball in the woods on the course today. It's been a while since I played, but hopefully we'll have a good time. Weather looks pretty nice out there.
For sure, for sure. Whether we play well or not.
Yeah, absolutely. In looking at different stuff going on in the market, I mean, if we come in before we actually dive into market action, there were a couple things that I did want to hit on. One of which is Catapult coming up. Want to mention that we have our flagship conference coming up September 29th to October 1st. It's in Nashville. Early bird pricing is up at the end of this month. So have 2 weeks from yesterday to get in to early bird pricing. Ends on June 30th there. Saves a couple $100 on the event. So for those that are interested, if you want more information, just go to the research hub, dorseyright.nasdaq.com, and you can see a little blurb there on the right-hand side that gives you some more info about it. But should be good. You'll be there in a cowboy hat on stage. Is that right?
That's the plan.
There we go.
Yeah. It's always the token thing to do while you're in Nashville, right?
Perfect. Yeah, I love how you updated your LinkedIn profile picture after a couple of years ago, I think it was, with the cowboy hat.
They took too many good headshots. So heck,
perfect. You got to
there.
Win in Rome or win in Nashville, I guess.
Yeah.
And then the other thing is we just started a model competition. Yep. So we have the NDW custom model competition. We've had a lot of interest in the model builder tool on the platform. So if you're following along, you're not on the platform, just bear with us for just a sec. We'll get into market stuff in just a few seconds. But we've had a lot of interest on, hey, what's this model like? Do I have the best one? So we're like, hey, let's see who has the best model. So it is a competition that is starting July 1st through October 1st. So it's a 3-month competition. The basic rules are you have to use the DWA custom modeler, and you have to have a model on that you cannot change after June 30th at 4 p.m. Have to submit to us the model by June 30th at 4 p.m. Just you can email us there, get more information on the research hub. And then we'll send out some leaderboards. The winner gets a few months of free elite subscription credit. So should be some fun stuff. We'll see who can come up with some good models.
Well, and it is worth bearing in mind that with those models, that if you haven't read it already, there are 2 sort of sets that we're doing based on just pure total return as well as then risk adjusted return.
Good point.
Kind of gives at least a layer or another layer of competition. So people aren't just going out and buying
loading up on
semis, right?
Loading up on semiconductors or maybe going the other way, maybe loading up on software. We'll see. Yeah, we'll get into a little bit of that. But yeah, a couple things going on there. We keep all of this up to date on the research hub. So if you're interested in the kind of what's going on, events, competition, stuff like that, definitely check out the research hub. So when we're looking at market action though, over the past week, so we're recording this 9:25 a.m. Eastern time on Wednesday morning. So market has not opened yet. It will open during this podcast. I was looking at performance over the past week, pretty strong gains across the board, and I was a little bit surprised by a couple things. So you get the Dow has outperformed the S&P over the past week, over the past month, and is within 1.5% of outperforming over the past 3 months and within and year to date. So it is close. The Dow and the S&P, I feel like people kind of write off the Dow. We've seen a lot of strength across the board from markets. I guess that's one thing that's indicative of that. But S&P up over 3.3% over the past week, still looks pretty strong there. David, so I was looking at sector performance. Yeah. We've seen semiconductors have killed it, obviously, over the past week, but technology is not the top performing sector. Without looking at the performance, and if you haven't already, what is the top performing sector over the past week?
Oh man, I have not looked at the performance, so I might, make myself look bad here. The that'd be even tough to say over this.
There's only 11. I've already removed.
Tech.
I've already taken out one of them. So
I mean, if it's not tech, I might say industrials, but
close. Industrials was second. Basic materials taking the top spot, up 6.57% based on market action through Tuesday. We have industrials there up 5.96, and then tech close to follow, up 4.35. So I was surprised to see that the technology's done well, but you're seeing all but three sectors.
But to your point, surprising to see something outpace it.
Right.
Is one of the things.
Yeah, absolutely. All but three sectors are up more than 3% or more than 2% over the past week. Just a lot of strong breadth across the board. Technology is definitely the best performer over the past 3 months. But seen a little bit of consolidation, I guess, over the past 1 month relative to some other areas.
In some fashion.
Yeah, in some areas.
For sure.
What do you think the worst performing is with that one?
I mean, at this point, after action to begin this week, one would imagine it has to be the energy space.
Ding, 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 ding. We have a winner. Energy is the worst performer over the course of the past week. And that was actually going to be the first kind of chart that we can dive in and take a look at there. Looking at XLE, I believe, right?
Yep.
You wrote a piece on the report. We actually had a couple pieces on energy over the course of the past few days, which I think speaks to how important or interesting, rather, some of the movement that we're seeing is. So here, looking at the chart of XLE, for those following along, 3.05 fund score, but maybe, David, for those that are not following along, did go to a sell signal, triple bottom break, right?
Yeah, break or triple bottom with yesterday's action, that being on the 16th. And even then, prior to that, when we saw that sort of initial down move on the 15th, that being Monday's trading, we actually saw XLE give a relative strength sell signal. So we've seen relative deterioration and at least now the beginnings of some trending deterioration as well. At least it's returning to a sell signal. One could definitely say there's still support in play. Before you're really
right at 54 there. Yeah. I mean, there's near-term support from those April lows and the pullback that we got there at 54. So, I mean, it's 3.05. It's not a terrible fund score. Seen a lot worse, but it was a lot higher. Down 2.72 points, negative score direction.
Yeah,
not great.
It was north of 5. It was to the extent that we were seeing leadership out of it for really was probably about a 3-month span. And now we're seeing many things indicating, to your point, we've written enough about it. There's been enough things going on that we've written 2 articles about it in the span of 2 days. So it was the amount of things that ultimately ended up transpiring sort of has been a catalyst for a lot of research into not only what we're seeing just within individual equities, but we've also seen crude oil breakdown as well, sort of coupling along with the breakdown in equities and energy.
Before we dive into the crude oil chart, because I do think we can go there, I do want to look at XLE for those that are not following along, or if you are following along, we're on a sell signal. We're still in a positive trend. So that's one thing to note. It was a clearly defined positive trend. We got 4 consecutive buy signals, consolidation. It's a triple bottom break. Kind of looks like a kind of a pseudo triangle pattern though, to back and forth consolidation. Yeah. If we get down further below 54, so falling to 53 would take out near-term support. From there, I think to me, you'd be looking at the upper 40s. That 48 to 50 range, 48 to 49 range, really, which is the previous highs that we got to twice back in 2024. We weren't able to get by higher than that throughout 2025, but you would expect some semblance of support. That also happens to align with the current position of the negative trend line. So if we continue to see a decline, that would be a reasonable area. I think you could see kind of some consolidation or
long-term line.
Yeah, kind of taking out that gap higher that we moved. If we do get energy to continue lower. And as you said, a lot of the movement that's been driving the XLE movement is crude oil. So looking at like CL / I mean, I don't know what chart scale you typically like to look at for here, but I definitely go up to at least a 2 point.
2 points a little bit nicer in terms of looking at it right now. That just sort of speaks to the level of volatility we've seen over the past really 3 to 4 months within the crude oil space. So slowing the chart down can be helpful, and it sort of reveals the information you need to take away anyways, and the fact that we've seen a significant break of support that had developed around that 80 or sort of upper 70s, but really right around that $80 level.
Right.
So that being taken out, you're sitting on 4 consecutive sell signals, this being a 2 point per box chart that we're currently examining. Definitely not leaving you with any type of rosy feeling towards crude oil exposure.
A lot of sharp back and forth action. I think the difference between the 2 charts is pretty notable to me, because you have XLE that kind of marched up to multi-year highs and then is pulling back down to like a next area of support, not anywhere near multi-year lows. Crude oil, on the other hand, has blown through support. It's only support from current level. It fell down to 76 yesterday. Its technical next support level is down
the lows
at
from 2025
multi-year lows of 56. I mean, so it's very different technical pictures, but I mean, one's a commodity, others are stocks, so it kind of makes sense, and they tend to be correlated in price action, but they're very different price action sometimes. Well, in terms of peaks and troughs.
And that's, I think, there's probably a variety of reasons for that. But I think in some of what we're looking at here maybe speaks to that separation and how people are maybe viewing their large cap energy exposure.
True.
Versus just like a commodities exposure. And I think, especially within a lot of portfolio management, it's easier to be okay cutting ties with commodities exposure just because of that. None of the associated or perceived volatility, the volatility we've seen over the past few months versus really, there's a little bit of that price volatility, but really you wouldn't even call it to the same magnitude within energy stocks. And there's still we always talk about some levels of diamond in the rough, even within sectors that have been downbeaten. You could argue that within some energy positions. They've given sales signals, but some of those that have given initial sales signals are falling from recent highs. So, there is context, I think, to your point, in terms of looking at both of these charts that you can glean from them for sure.
Yeah, absolutely. And when we're looking at other areas of market action, I guess, as it were, right? So you have energy on one end that has fallen out of bed. We've seen it decline. What you said, it fell down to third in Dolly. Is that right?
Over the past 2 days, just sort of beginning even this week, we've seen energy drop 27 signals.
27. Wow.
Yeah, within Dolly. So pretty abrupt signal deterioration, which can kind of sometimes speak to the fact that you'd already seen some of that near-term deterioration that finally just had its catalyst to sort of push it over the edge. And that's, I think, what we've seen in a lot of fashion in terms of the breakdown on trending charts, the action we've seen within energy indicators, and now it's rolled over into a relative story where it's fallen in Dolly from that top spot that it held.
Yeah. I mean, the month-over-month basis, it's been about halfway through the month, a little over halfway through the month. Energy dropped 46 signals. Tech's picked up 5, so still far and away the leader, but only picked up 5. Industrials picked up 16. We've seen financials pick up 12. We've seen healthcare pick up 16. So there's some interesting movers against some of those areas that haven't seen a lot of action, financials and healthcare in particular, and industrials have seen certainly decline in strength, but seeing those areas kind of bounce back a little bit will be interesting to watch as we move into the summer months, which tends to be pretty low from a volatility perspective in the summer. So we'll kind of see what shakes out there as we keep moving forward.
But we often think of summer as low volatility, but we did have last weekend start with a pretty crazy IPO and lead to more interesting action.
Yeah, the weekend, the Friday action in particular has seen some sharp movement so far this year. I mean, the Friday before that we got way down 4+% for a lot of major indices. I mean, when speaking at low volatility, that doesn't mean we can't have sharp days. We actually did a piece earlier this week and looking at sharp days and market action, like the number of 1% moves in either direction for the S&P. June and July are typically the lowest months with the lowest counts of 1% days historically. And we're slightly under pace on a year-to-date basis in terms of the number of 1% days in market action. So I don't know, you would expect a little bit of mean reversion to a degree, but we've gone years without breaking above the average. The average is there for a reason. Some years see a lot of 1% days, other years.
Well, we're coming off of years where it's kind of been the case where it's been slightly above average. And so we're going through a slightly below average year now.
Yeah. We'll see what kind of shakes out there moving forward. One area of the market, though, that has certainly seen its fair share of 1% days is semiconductors.
Yeah.
We were talking about
plus and minus 1% days.
A lot of plus, I would say,
but a lot of
so
plus,
far. Yeah. Those areas are getting pretty extended, have been extended, continuing to extend, I guess, when you look at a lot of the charts. I think there were a couple interesting charts that we're looking at. One of the biggest names that we'll see is SMH from an ETF perspective. We won't look at the individual stocks for now, but you're looking at SMH at 74 billion there. 5.94 fund score, still a positive score direction, up 70% year to date, trading on 4 consecutive buy signals, not in overbought territory anymore. It's a gorgeous looking chart.
Yeah, rallied to match its high during Monday's trading. You're even getting a little bit of a pullback, and I mean, right around that 600.
Pulled back notably yesterday.
Yes,
down 4.8% yesterday, which it was extended prior to that move. So I think that's an important thing to note. We are now just 66% overbought. So
right.
we're still close to what we would consider to be extended, but not as extended as we were.
Well, and as it might even seem to some folks, they might look at the chart currently and think a pullback to 600, really? But I mean, for the health of the chart and also even sort of an actual territory, yeah, that's sort of that's where you're right around.
You won't even reverse down into a column of those until you hit 600.
Yep.
On the default chart. Initial support doesn't even come in until 570.
Yeah. So between there and that 600 range.
Just speaks to the, I mean, it's up 70% year to date. 71%, sorry.
Much
even,
of that
even with yesterday's move.
With that, after it gave that buy signal back in April, you saw it march above the $400 level and basically clear through the $500 level within a matter of weeks. So.
And we've got support at 570. We've got further support down there at 530, which happens to be the middle of its trading band. That would be 0% from a weekly overbought oversold perspective. And then further support down there at 485. So if it went down to 485, wouldn't be a great sign, but you got a lot of support levels baked in. I wouldn't be surprised to see some back and forth action from semiconductors. Maybe they should continue to run higher. Maybe we get some areas of strength. But one thing that we were talking about, you see SMH is up 71%. If you look at the holdings, so one of the cool things you can do on the Dorsey Wright page, if you're on the chart page, for those following along, you click on the holdings button. You can see the stock weighting at the end of the last month that we had. So NVIDIA up there over 15%, TSM 9.3%, Micron 7.7%. I mean, you have 6 stocks that are 7% or more within this fund. So a lot, it's cap weighted. I mean, it's just the biggest names get the highest weightings. Other areas of the semiconductor space like XSD, the State Street Spider S&P Semiconductor ETF, it's a modified cap weighted. So you look at the holdings for this, it has a few areas like Max Linear is its highest weighting at 6%. AMD up there is 3%. NVIDIA is pretty far down the list. I'm still scrolling here. Don't even see it up at the top of the weightings anywhere.
Definitely some names within XSD that, within that top 10, like you're mentioning, that you'll recognize, but also ones that, generally aren't getting as much attention as that upper echelon of semiconductor
NVIDIA 1.6% of the weighting, right? Now this fund, 5.14 fund score, hasn't seen as much consistent improvement, but it's up 85% year to date. It's actually done better. Now, from a momentum perspective, the cap-weighted area still has a better technical picture. But just from a straight performance perspective, you've seen this more kind of modified equal weight area be stronger. It's up more, right? And I think that speaks to the breadth that we've seen in the semiconductor space. It's not just NVIDIA carrying the market higher, NVIDIA, Intel, AMD, some of these. It's other areas that are showing a lot of improvement. The whole space is just doing really well.
Well, and sort of, I think where you're driving the point here is the fact that some of those names that we've seen also improve, helping out XSD, aren't names many probably have heard from. And in many cases, it's because they're small cap names.
Right.
And that's really kind of permeated elsewhere within the market, and small caps have seen that benefit, especially in the near term.
Yeah, one of the charts I'm going to now for those following along, the BP for semis, BP semi. I think it's a pretty interesting looking chart. It sees a lot of back and forth action, but we saw it actually peak back in April up at 84 is when it peaked in mid-April there. And hasn't been able to get higher than that since. It's actually seen a continuous series of lower highs, lower peaks on other ascents, and now it's kind of 68%. Can't get back up to the 72% level that we were at earlier this month. So that'll be interesting to watch. I mean, the majority of action for any of these charts tend to happen between 30 to 70. So it's saying, hey, we might not be at the blow off top that we're seeing again. Maybe we won't get another 50% month or 25% month, but we could still get like a 5% month. And they can still continue to do well moving forward. Just with this level of improvement, still good, I guess, right?
Yeah, it at this point, it still suggests that you're seeing enough stocks when that shift happens, return to buy signals, that helpfully pushes things higher. if this indicator would have stayed, looking at the BP, if it would have stayed below 50% on this recent rally, different context, different conversation.
Right. Yeah, that's a good point. It's not like we're seeing we're getting close. We're maybe not quite there, but that's kind of to be expected.
Yeah. I mean, in some fashion, you eventually have, in any race, somebody eventually gets tired, right? So it's sort of, we're keeping an eye out for it right now. It still appears to have enough fuel to kind of keep what it's been doing this year, but that's the next line that I feel like everybody's watching for. And that just to give some context of, in terms of how we look at these indicators, if we don't see it rally back up to prior levels that we were just at, that deserves its own context and realizing, hey, we might be seeing participation continuing to wane. But for the time being, sort of a sit on our hands and let's keep just rolling.
Still strong. Could be some buy and pullback opportunities in there coming in. Still strong area. But that's why we have the indicators, right? We have the indicators to follow. They're not predictors. They look at historical market action and kind of give us an understanding of where we sit, right? And so that's why we kind of ride the trends until they change.
Yep.
And one of the trends that has seen a lot of consistency recently, kind of pivoting a little bit, is small caps.
Yeah.
We're looking at, you could look at a lot of different charts for small caps. One of the ones that I was looking at that shows some pretty consistent market action is IJR. You look at the small cap 600 ETF there from iShares. You talk about a consistent technical picture over the past few years. Consolidation throughout 23, started breaking higher in 2024, peaked out at 128 with consecutive buy signals. Then you got a string of consecutive sell signals consolidating in April of 2025, broke out back to a buy signal, really hasn't looked back. It's just shown consistency. It's on its fourth consecutive buy signal. Most recent buy signal was given back in April. Trading here at all-time highs that it reached just last week, up at 144.
Last
Friday. Yeah, there you go. Up 18% year to date, 4.49 technical picture. Small caps look pretty good here.
Yeah, and it's interesting, I think, because beginning of the year, that catalyst for small caps was slightly different. And now we've seen that transition into kind of tying back to what we were mentioning a moment ago. You've seen those small cap semis or small cap tech related names really see improvement here recently. Whereas beginning of the year, we were talking about small cap energy, and being a primary driver there. So small caps is still in factor and being in play. But what's helping it maintain its stature has changed under the hood, if you will. So I think that's a lot of where our context is sort of trying to drive here is we've started to see this energy breakdown, but we've had small caps, as far as tech's concerned, be there to help out and sort of pick up the slack.
Right. And I think an area within healthcare that's done well is like biotechs, right? And so it's some of those areas.
Another one.
Definitely in some of the small cap, mid cap areas that have shown some strength recently. At the end of the day, it's just more breadth in the marketplace, right? We're seeing more areas do well is a good sign for market action. I think when we look at things that are maybe going to affect breadth or action moving forward, obviously all eyes, we're recording this, it's 9:45 now. We have a Fed meeting today. There's been some interesting movement in interest rate expectations for Fed rate hikes throughout the course of the next year.
For sure.
Maybe a lot of eyes are going to be on the dot plot this afternoon. By the time this podcast comes out, that would have come out. So I don't want to say anything stale, but we will look at the current technical picture for TNX. I think can kind of help show maybe some action that we can kind of adhere on in terms of things that we might look toward moving forward. TNX, obviously the 10-year yield. I think people get fearful when this is high, right? That to be expected there. October 2023, we got there again in January 2025, up above for 47.50 here on the chart, which would be a kind of 475 from a yield perspective. We recently peaked out at 46.50 and have reversed down into a column of those in May down to the 44.50 level. We haven't seen any action thus far on the default chart in June, which I think is notable.
Even with the thought of all these perceived changing rate expectations, and the fact that it's sort of just hanging tight.
Right, exactly. And it's not, we broke slightly higher than we got to in last May, which started to raise some flags for people. A lot of people looking at 30-year 2, which broke out a little bit north of that. At the end of the day here, I mean, we're seeing pretty normal action. We're not seeing massive runs from this. It's showing more muted peaks, but also more muted troughs. When we got a decline in the TNX starting last June, we got 4 consecutive sell signals down there to 39.50 by October. That was a higher low than we got to in April, which was 39. Not much, but a higher low.
Slight.
That was also a higher low than we got to in September of 2024, which was down at 36.50. So I mean, you're just kind of seeing like long-term broad consolidation with this moving forward, which gives you a tighter range. Now, I think fears would be that tighter range kind of is it coiling up to spring in a different direction. Rates don't tend to move like that historically, unless we get to wild action. You know what I mean, from the Fed, some unexpected move. I think it's pretty good to see. I mean, kind of the back and forth action here, kind of consolidating there. Given some of the words that the Fed Chair Warsh has said, we'll see what he says this afternoon. I don't know if I have a ton of don't have any expectations or predictions on it, but I think wouldn't be a bad thing to see. It's kind of more tighter range moving forward.
Yeah, I mean, and in a way we've seen, especially if you even slow that scale down, it makes that tighter range a little more pronounced, if you will. But even then, it, I think, conveys a lot of different things in terms of what's ultimately driving some of this market action. But I mean, at the moment, I think where we end up is, while there's sort of conjecture about potential expectations, what may be going on here, what's perceived here, there, and everywhere. The important part is we've seen the chart sort of meander its way along and be a little more consistent in helping us understand, all right, we're hearing a lot, but here's actually what's occurred in terms of interest rate movement. So it is one of those times where you think back to TD saying we don't have TVs in the office for a reason. You know, it's sort of blocking
we do have TV
out.
now.
We do, but
we're watching soccer on it. Not
as much market action. But point being is, this can sort of provide the context when it feels like there's so many moving targets. And I think that's a lot of what we're trying to get to, is that while it's still consolidating, you know, we're kind of waiting for more bigger action to happen, really.
Yeah, for sure. So we'll see what happens after this afternoon, but I think it's important to keep an eye on those kind of charts as we look toward, hey, you hear all these stuff about what's going on with rates, what's going on with expectations. Like, let's take a look at charts, see what it says.
Exactly.
Well said. So I'll leave you, David. What's your prediction for the World Cup? I know you played soccer, right? Who you got? Going to a lot of soccer games for your kids?
I mean, honestly, I've been going to a lot of soccer games, yelling at a lot of refs. But I will say one thing: I was thoroughly impressed by Team USA.
Okay.
It's felt like a long time. I mean, even going back to when I was a kid, that Team USA felt good.
Yeah.
And those were sort of what even people talk back to as the golden days of U.S. soccer, which makes me feel old. But anyways, Team USA has definitely impressed me. But honestly, the thing I've been surprised by the most is almost the parity within some of the teams. I mean, the other day it was like the other day 4 ties, and really probably 3 of the matches should have been perceived kind of slaughterfests. But this will be a wild one to watch, especially if we keep seeing ties, and who knows who pops in then.
Yeah, that makes some of the groups pretty tight there, as you can get some big upsets potentially.
Oh yeah,
that could be fun. Well, all our eyes would be on the next U.S. game is Friday at 3 p.m. I think.
I think so.
Market happens to be closed. It's not closed for Juneteenth, not closed for the World Cup game, but I think a lot of people will be watching the World Cup game.
I mean, there was maybe some convenience in scheduling.
There you go. Well, cool. David, thanks for hopping on. Let me join you here. Always good to have you. Thanks everyone for tuning in this week, and we'll be back to touch base on any other market action next week.